Germany is no longer the real powerhouse, to be honest, because we have been in a de facto 5-year stagnation. EU clearly needs to watch out that it doesn't pour oil into the fire, a fire that is currently called a global trade war. The market turmoil will clearly have a direct impact on average people if they own stocks. So if they just saw a big part of their stock portfolio just evaporating.
European markets are in turmoil following President Trump's new tariffs. Joining me now is Carsten Brzeski, chief economist at ING Germany. Thank you very much for joining me, Carsten. I'm just going to come out and say it. Are we hurtling towards a global recession?
It currently looks like it, in all honesty. Well, we never know because Donald Trump can change his mind. But if these tariffs remain, if these tariffs become effective, then we are really at the start, not only of a US recession, but also of a global slowdown, which could even end in a recession.
So stocks have tumbled worldwide, including in Germany, which has already been struggling. So do you think Europe's economic powerhouse is at risk of an even deeper recession now?
Yeah, Germany is no longer the real powerhouse, to be honest, because we have been in a de facto 5-year stagnation. With what's going on right now, and always assuming that these tariffs on European goods really become effective come April 9th, will clearly weigh on the German economy. The German economy has already some industrial issues, and Germany exports more than 150 billion euro per year to the US. So if these are now subject to tariffs, one way or the other, the German export sector will notice it. But that's only the direct impact. We will also see an indirect impact via confidence channels. So the risk has clearly increased that the near-term outlook for Germany will bring another contraction, despite all the optimism we had a couple of weeks ago when we saw the fiscal U-turn in Berlin.
And just before recording, we got the news that the EU is offering a free trade deal with the US on cars and other industrial goods. Do you think offering concessions is the right thing for the EU to be doing right now, or is it just justifying Trump's hardline stance?
That's also a very difficult question, Daniel. I think there is no right strategy currently. What the EU has just repeated is actually an offer they made years ago. So, because the EU had always been open to really a free trade deal with the US. So that is nothing new. I think what the EU is now trying to achieve is they offer stick and carrot. On the one hand, they announced that there will be the tariff stick, that they will also increase tariffs. And on the other hand, I think that is a way to negotiate with the Trump administration, showing that, well, we could go for a free trade agreement between the US and the EU as well. In all honesty, I think that the Trump administration currently needs revenues from these tariffs so that there is very little room for negotiations.
OK, so if we put you in charge of the European Commission, what other options would you be looking at from the EU's perspective? After all, retaliation could harm the EU economy further.
Yeah, well, being then a good European civil servant, I would clearly kind of circumvent your question and would answer, well, I would strengthen the domestic economy. That has nothing to do with trade policies. I would tell you, please really start investing in the European economy. Try to implement all the policy recommendations that Mario Draghi made last year when he was clearly pointing at the weakness of European competitiveness. But I think in the end, this is the only way out. So Europe, of course, needs to deal and to negotiate with the US. But the only way forward for the EU and for Europe is to strengthen the own domestic economy. Coming back then to trade, what are the options that they could do if the Trump administration would really be willing to strike a deal? Europe should, of course, threaten. Europe should start to show that they have trade policies, that they can also put some harm on US exporters. And the nuclear option currently in the European trade policy toolkit is clearly tariffs on services. I don't know whether I would go that far, but that is clearly an option the EU will also flag to the US administration.
Okay, so you think the EU should be tougher on some things. And, Trump has said, talking a bit about services and other areas, that it's not just about the tariffs. It's about the EU's regulations on things like food, making it more difficult for the US to export to the EU, or even fines on social media companies that the US thinks are just far too tough. Do you think the EU will consider getting rid of some of these so-called non-tariff barriers as well?
I think the EU will always be willing to look into these issues, and the EU will always be interested in having a talk. The only question is whether it is more or less bullying the EU to the negotiation table is the right strategy from a US point of view. I think the last couple of days and weeks have clearly shattered the European belief or trust in the reliability of the US as a partner. So I think this is something. So a lot of confidence, trust has been broken over the last couple of weeks, and I think that is something that needs to be fixed first, because before you can really go into serious negotiations.
All right. I want to talk about escalation now, expansion of tariffs from the EU perspective. Do you think that the EU will have to put tariffs on China? Because there's worries that a lot of goods that were destined for the US could land in Europe instead, putting pressure on European businesses.
I think the EU clearly needs to watch out that it doesn't pour oil into the fire, a fire that is currently called a global trade war. So the EU needs to be very careful. Of course, an instinct or a reflex will tell you, well, if China, as it will be harder to export from China to the US right now, if China was to come to Europe and would to flood the European market with prices or with dumping prices, clearly that would also come at the expense or at the cost of the European industry, something that the European industry or an economy doesn't really want to see. But does it really mean that the EU should then also get into a new protectionist kind of wave vis-a-vis China? I think they need to be very careful, because we also know that the EU is still highly depending on China. So I would expect really more diplomatic skills coming out of the EU when dealing with China than what we're currently seeing on the other side of the Atlantic Ocean.
Okay, you mentioned oil on the fire. Well, that oil might be quite a bit cheaper now because it's dropped to its lowest levels since 2021 due to those fears of the global recession. Is this a small upside for Europe, or does it come with its own problems?
No, that is definitely an upside. Well, of course, the origin why oil prices are so low is not really an upside, because markets are pricing in a global recession. So, and the result of that is dropping oil prices. So if the global recession really was to materialize, an open economy, an export-dependent economy like the European economy would also suffer. But back to the lower level of oil prices, that is clearly positive news for Europe, especially now that we came out of the winter and energy prices coming up. Also, we look at gas prices in Europe. The gas inventories have clearly been extremely low. So lower oil prices, lower energy prices are good news for Europe. It will, and that is the funny thing, while the trade tensions are very likely to push up inflation in the US, we see that as a result of this trade escalation, there will be more disinflationary pressure in Europe. So lower inflationary pressure, which then in turn would also offer the European Central Bank more possibilities to continue cutting interest rates. And that in turn would also be a positive for the European economy.
Okay, so maybe some light towards the end of the tunnel. I want to talk then about Germany's plans to borrow hundreds of billions of euros with the next government. Markets are now charging the German government less than before to borrow. But does all of this economic disruption, like you mentioned with oil, perhaps even undo this small benefit?
No, not really. I think, and that is the good thing about this fiscal U-turn we saw a month ago. Because this will come, and it has to come. And of course, the German government, no government should really make such longer-term structural investment decisions based on day-to-day volatility of interest rates. I think when you look at the absolute level of long-term interest rates for Germany, 10-year government bond yields are still around to 2.50, 2.60% right now. That is still extremely low. So which means this will not hinder the implementation of the fiscal stimulus. The coalition talks in Berlin might still hinder it, but I think this is clearly the best joker card, the best wild card that Germany currently has to offer, facing near-term downside pressure stemming from these trade wars. So the only thing that I hope is that next to this fiscal U-turn, we will also get a new coalition that will bring more structural reforms. Because no matter where interest rates are right now, I think that the bigger challenge for the next government will really be to implement these investments in a very efficient way, to bring it down into the economy. And there, the level of interest rates doesn't matter. The level of bureaucracy does matter. The level of regulation does matter, and also the level of structural impediments does matter. So reduce all these three, and no matter how high the interest rate is, the German government can really implement fiscal stimulus.
Okay, and Germany is a very export-focused nation, and with investors fleeing to safe havens, the euro has strengthened against the dollar. Are you expecting this to make a bad situation for European exports even worse, making EU goods perhaps just too expensive?
Yeah, you could argue that normally a stronger exchange rate, a stronger currency is negative for exports. I think currently the level of the euro exchange rate is not what concerns exporters most. It clearly is the level of tariffs that has been announced, that matters most. Of course, when you now look at the bilateral exchange rate that you're mentioning, so with the euro dollar now being close to 110, while a couple of weeks ago people were speculating about when will we reach parity. So which means European products in the US have already become more expensive. If now on top of that we'll get the tariffs, clearly it will add to the cost pressure, and it will clearly worsen the competitiveness of European exporters, producers in the US.
Okay, so let's just kind of break this down to kind of a more manageable level. We're talking about all of these huge things. For the average European citizen, what kind of tangible effects might these market upheavals that we've seen have on their daily lives in the coming months?
Well, the market turmoil will clearly have a direct impact on average people if they own stocks. So if they just saw a big part of their stock portfolio just evaporating, that is going to hurt their consumption behavior. That is point number one. When you look at the trade tensions, how are the trade tensions affecting the average or the ordinary European citizen? The first thing is, if the ordinary citizen works in an export-oriented industry, he or she will see that the company will get under pressure, and that eventually there might even be some jobs at risk longer term. And that is clearly how it will feel. But as we know that a big part of the European and especially the German industry is depending on the export industry. So even if you yourself have nothing to do with the export industry, if someone else in your city starts losing his or her job because he or she works in the export industry, this could also mean that the retail stores will see less demand, that the entire economy will slow down. Is inflation a big concern for people right now? No, it shouldn't, because I think that is important. The current trade tensions will be inflationary in the US, but not so much in Europe. Whether they will be inflationary in the longer run will clearly depend on the European reaction. If the EU was to impose tariffs itself, think, for example, on digital services, so that you and I will be charged more on our digital services, at least if we get it from US providers, that would then start increasing inflation. But right now, it's more the negative impact on wealth via the stock market correction. It is the potential risk of job losses for people working in the export industry. And in the end, in the longer run, It could be inflationary, but not for now.
Okay, just to end, I want to kind of circle back round to where we started, the risk of global recession. We've had a lot of downside in this conversation and a few little glimmers of upside. How would you rate Europe's resiliency in the face of such an economic crisis?
I think the good thing is of the last couple of years, Europe has learned how to do crisis. I think we're not so strong in implementing longer term structural reforms, but we have clearly grown in tackling imminent crisis. We saw this during the pandemic. We saw this during the energy price crisis. So we have our experiences. So which gives hope that if due to this tariff escalation, the trade escalation, we really were to see Europe slowing down, Europe moving into recession, we still have governments that are able to tackle such a slowdown via short-lived temporary fiscal stimulus measures. So there is some resilience there already, but then it will depend on, is Europe able to use this current situation? And we've had so many wake-up calls over the last couple of weeks, be them on security, be them now on trade. So if Europe has really woken up, and this woken up means if they now really start investing in own autonomy, in strategic autonomy, and strengthening the European domestic economy, this would clearly benefit our resilience.
Okay, so Europe needs to get tough, including tough on itself. Carsten Brzeski, thank you very much for your analysis.